Look, I need to tell you something that's going to sound crazy at first, but stick with me, because what I'm about to show you is backed by thousands of years of history and some very recent data that Wall Street doesn't want you paying attention to. Your savings account? That thing you've been told is safe? It's not a savings plan. It's a slow-motion wealth transfer. And the people who understand this aren't putting their money in dollars anymore. They're putting it in metal. Now, before you think this is some conspiracy theory, let me show you exactly what's happening right now in the global financial system. Because while you've been watching your savings account earn 0.5% interest, something massive has been unfolding behind the scenes. Central banks around the world have been buying gold at a pace we haven't seen in over 50 years. We're talking about 710 tons per quarter. That's not a typo. 710 tons every 3 months. These are the same institutions that control the money supply, that set interest rates, that supposedly have all the confidence in the world in their own currencies. And they're dumping those currencies to buy physical metal. Why would they do that? Think about it. These aren't amateur investors. These are the people who literally print money. They have access to information you and I will never see. They understand the mechanics of the financial system better than anyone. And they're moving their reserves out of paper and into gold. Let me paint you a picture of what's really going on. Imagine you're at a poker table. You've been playing for hours, and you notice something strange. The dealer, the person running the game, starts quietly cashing in their chips. Not all at once, just steadily, consistently, week after week. What would that tell you about the game you're playing? That's exactly what's happening in the global financial system right now. The dealers, the central banks, are cashing in their paper for metal. And they're doing it while telling everyone else that everything is fine, that the dollar is strong, that inflation is transitory. But here's what they're not telling you. The dollar has lost over 98% of its purchasing power since 1971. That's not ancient history. That's within living memory. Your grandparents could buy a house for $25,000. Today, that same house costs $400,000. Did the house change? Did it suddenly become 16 times better? No. The dollar became 16 times weaker, and it's accelerating. In just the past few years, we've seen the money supply expand by trillions. Every time the government prints another $1 trillion, every dollar you own becomes worth less. It's not complicated economics. It's simple math. More dollars chasing the same amount of goods means each dollar buys less. Now here's where it gets interesting. Gold doesn't work that way. You can't print gold. You can't create it out of thin air with a computer keystroke. It has to be pulled out of the ground, refined, and stored. It's real. It's tangible. It's finite. And that's exactly why it's been money for over 5,000 years. Every civilization that's ever existed has recognized gold as a store of value. The Egyptians, the Romans, the Chinese dynasties, the British Empire, they all used gold. And every civilization that tried to replace gold with paper money eventually saw that paper money collapse. Let me tell you a story that perfectly illustrates this. In 1971, President Nixon did something that changed the world forever. He closed the gold window. Up until that point, the dollar was backed by gold. You could theoretically take your dollars to the government and exchange them for gold at a fixed rate. That backing gave the dollar credibility. It meant the government couldn't just print unlimited money because they had to have gold to back it up. But in 1971, that ended. Nixon said, "We're going off the gold standard." And from that moment on, the dollar became what's called a fiat currency. It's worth something only because the government says it's worth something. There's nothing backing it except faith and the threat of force. What happened next? Inflation exploded. The 1970s saw some of the worst inflation in American history. People who had saved their whole lives in dollars watched their purchasing power evaporate. Meanwhile, gold went from $35 an ounce to over $800 an ounce by 1980. That's a 200% increase in less than a decade. The people who understood what was happening, who moved their wealth into gold, preserved their purchasing power. The people who stayed in dollars got destroyed. Now, fast forward to today. We're seeing the exact same pattern, but on a much larger scale. The money printing that happened in the 1970s looks quaint compared to what's happening now. We've added more to the money supply in the past few years than in the entire previous history of the country combined. And just like in the 1970s, gold is responding. It's hit record highs, breaking through $3,400 per ounce. But here's what most people don't understand. This isn't just about the price going up. This is about gold maintaining its purchasing power while the dollar loses its purchasing power. Think about it this way. An ounce of gold has always been able to buy roughly the same amount of goods. In ancient Rome, an ounce of gold could buy a fine toga, a belt, and a pair of sandals. Basically, a nice outfit. Today, an ounce of gold at $3,400 can still buy you a nice outfit. The gold didn't change. The measuring stick, the dollar, changed. That's the key insight that most people miss. Gold isn't an investment that goes up and down. It's a constant. It's the measuring stick. Everything else, all the paper currencies, they're the things that fluctuate in value relative to gold. And right now, we're in a moment where that relationship is becoming impossible to ignore. The dollar is weakening at an accelerating rate, and gold is reflecting that weakness by reaching new highs in dollar terms. But it's not just about inflation. There's something else happening that's even more significant. The global financial system is going through a fundamental restructuring. For the past 80 years, the dollar has been the world's reserve currency. Every country needed dollars to trade internationally. Oil was priced in dollars. Commodities were priced in dollars. If you wanted to do business globally, you needed dollars. That system is breaking down. Countries are starting to trade in their own currencies. China and Russia are settling trades in yuan and rubles. Saudi Arabia is accepting payment for oil in currencies other than dollars. The BRICS nations are working on creating an alternative to the dollar-based system. What does this mean for you? It means the demand for dollars is going to decrease. And when demand for something decreases while the supply is increasing, the value drops. That's basic economics. And what are these countries buying as they move away from the dollar? Gold. They're not replacing dollars with euros or yen or yuan. They're replacing dollars with gold, because they understand that gold is the only truly neutral reserve asset. It's not controlled by any government. It can't be sanctioned. It can't be frozen. It can't be printed. Now, let me address something important here. If you're sitting on a significant amount of retirement savings, $100,000 or more, you need to understand how this affects you specifically, because most retirement accounts are denominated in dollars. Your 401k, your IRA, they're all measured in dollars. And if the dollar is losing purchasing power, your retirement is losing purchasing power. There's actually a way to hold physical gold inside a retirement account without triggering taxes or penalties. It's called a gold IRA. I put together a free guide that explains exactly how it works, what the rules are, and how to set one up properly. You'll find it in the description below. It's worth looking at if you're concerned about protecting your retirement from currency devaluation. All right, back to what's happening in the markets right now, because there's another layer to this story that makes it even more compelling. The physical gold market is completely different from the paper gold market. Most people don't realize this, but when you see the gold price quoted on financial news, that's not the price of physical gold. That's the price of gold futures contracts traded on exchanges like the COMEX. These are paper contracts that represent gold, but most of them never result in actual physical delivery. In fact, the ratio of paper gold to physical gold is estimated to be somewhere between 100 to 1 and 250 to 1. That means for every ounce of physical gold that actually exists, there are 100 to 250 paper claims on that gold. It's fractional reserve banking applied to gold. Now, what happens when people start demanding physical delivery? When they stop accepting paper promises and start wanting the actual metal, that's when you get what's called a squeeze, and there are signs that we're heading into exactly that situation. Look at what's happening with gold ETFs. These are funds that supposedly hold physical gold and allow you to buy shares representing that gold. In recent months, we've seen massive inflows into these ETFs, billions of dollars pouring in. That means the ETFs need to go out and buy physical gold to back those shares. But here's the problem. The physical gold market is much smaller than people think. Annual gold production is only about 3,000 tons. That sounds like a lot until you realize that central banks alone are buying over 2,800 tons per year. Add in jewelry demand, industrial demand, and investment demand, and you quickly realize there's not much gold available. What happens when demand exceeds supply? Prices rise. But in the gold market, it's more complicated than that. Because of the paper market, prices can be suppressed in the short term through the creation of more paper contracts. But eventually, physical reality asserts itself. You can't deliver paper when someone demands metal. And that's the situation we're building toward. A moment when the paper market breaks down and the price of physical gold separates from the price of paper gold. When that happens, the price discovery mechanism shifts entirely to the physical market. And in a physical market with limited supply and massive demand, prices can move very quickly. We've seen this before. In 1980, gold briefly touched $850 an ounce. Adjusted for inflation, that's over $3,000 in today's dollars. But here's what's different now. In 1980, the U.S. was the world's largest creditor nation. Today, we're the world's largest debtor nation. In 1980, the federal debt was less than $1 trillion. Today, it's over $36 trillion. In 1980, the dollar was still relatively new to being a pure fiat currency. Today, we're 50-plus years into the fiat experiment and the cracks are showing. Every metric that matters is worse today than it was in 1980. And yet, gold is only now reaching the inflation-adjusted equivalent of its 1980 peak. That tells you something important. Gold isn't overvalued. If anything, it's undervalued relative to the scale of the monetary problems we're facing. Let me give you another historical parallel. In 2008, during the financial crisis, gold was around $800 an ounce. Over the next 3 years, it more than doubled, reaching over $1,900 by 2011. Why? Because the Federal Reserve responded to the crisis by printing trillions of dollars. Quantitative easing, they called it. A fancy term for creating money out of thin air. Investors who understood what was happening moved into gold. They recognized that the Fed's response to the crisis was going to devalue the dollar, and they were right. Gold preserved their wealth while dollar-denominated assets went through massive volatility. Now, compare that to what's happening today. The money printing in 2008 looks tiny compared to what we've done in recent years. We've printed more money, created more debt, and expanded the Fed's balance sheet to levels that would have been unthinkable just a few years ago. And we're seeing the same response. Gold is moving higher, reflecting the devaluation of the currency. But there's something else happening now that didn't happen in 2008. The geopolitical landscape is shifting. We're seeing the emergence of a multipolar world where the U.S. doesn't have the same level of dominance it once had. Countries are choosing sides. Alliances are forming. And in this environment, gold becomes even more important because it's the one asset that every country recognizes as valuable. Think about what's happening with Russia. After the invasion of Ukraine, Western countries froze Russia's dollar reserves. Billions of dollars that Russia thought were safe, that they thought were their sovereign wealth, were suddenly inaccessible. That sent a message to every country in the world. Your dollar reserves aren't really yours. They can be taken away if you do something the U.S. doesn't like. What's the response? Countries are diversifying out of dollars and into gold. Because you can't freeze gold that's sitting in a vault in Beijing or Moscow or New Delhi. It's physical. It's sovereign. It's truly owned by whoever possesses it. This is driving a fundamental shift in how countries think about reserves. For decades, the playbook was simple. Earn dollars through trade, invest those dollars in U.S. Treasury bonds, and hold them as reserves. That system is breaking down. Countries are realizing that dollar reserves come with political risk. And they're moving into gold as a result. China is a perfect example. They've been steadily increasing their gold reserves for years. But here's what's interesting. Most analysts believe China's official gold holdings are significantly understated. They think China has been buying gold through unofficial channels and not reporting it. Why would they do that? Because if the market knew how much gold China was really buying, it would drive the price up before they finished accumulating. This is the kind of strategic thinking that happens at the nation-state level. These aren't emotional decisions. These are calculated moves based on deep analysis of where the global financial system is heading. and they're all pointing in the same direction, toward gold. Now, let's talk about silver for a moment, because while gold gets all the attention, silver might actually be the more interesting story. Silver has all the monetary properties of gold. It's been used as money for thousands of years. It's rare, it's durable, it's divisible. But it also has something gold doesn't have: massive industrial demand. Silver is used in solar panels, in electronics, in medical applications, in water purification. It's an essential industrial metal. And as the world moves toward green energy and advanced technology, demand for silver is increasing dramatically. But here's the problem: silver production is relatively flat. Most silver comes as a byproduct of mining other metals like copper and zinc. You can't just decide to mine more silver. It doesn't work that way. So you have increasing demand running into relatively fixed supply. What does that mean for price? Well, historically, the gold to silver ratio has averaged around 15 to 1. That means it took 15 ounces of silver to buy 1 ounce of gold. Today, that ratio is around 85 to 1. Silver is historically cheap relative to gold. Now, I'm not saying silver is going to return to a 15 to 1 ratio tomorrow, but even a move back toward the historical average would mean significant gains for silver. And if we see the kind of monetary crisis that many analysts are predicting, silver could outperform gold substantially. There's another factor with silver that's worth understanding. The silver market is much smaller than the gold market. It takes less money to move the price. When investment demand for silver picks up, it can create explosive price movements. We saw this in 2011 when silver briefly touched $50 an ounce. It went from $18 to $50 in less than a year. That's the kind of volatility that creates life-changing returns for people who position themselves correctly. But here's what you need to understand about both gold and silver. This isn't about getting rich quick. This is about preserving wealth. It's about making sure that the money you've worked your whole life to save doesn't evaporate because of monetary policy decisions made by people you'll never meet. Think about your grandparents or great-grandparents. If they had saved $10,000 in 1971, what would that be worth today? In dollar terms, it would still be $10,000, but in purchasing power terms, it would be worth less than $1,500. They would have lost 85% of their wealth just by holding dollars. Now, what if they had taken that $10,000 and bought gold in 1971 when it was $35 an ounce? They would have bought about 285 ounces. Today, at $3,400 an ounce, that would be worth nearly $970,000. Same amount of money, same time period, but one decision preserved and grew wealth, while the other destroyed it. That's the power of understanding what money really is. Money isn't paper. Money isn't digits in a computer. Money is something that holds its value over time. And for thousands of years, that's been gold and silver. Now, I know what some of you are thinking, but gold doesn't pay interest. It doesn't pay dividends. It just sits there. And you're right. Gold doesn't generate cash flow. But that's not its purpose. Gold is insurance. It's the asset you hold to protect against the devaluation of everything else. Think about it this way. You pay for car insurance every month. That money doesn't generate a return. It doesn't pay you dividends. But you pay it anyway because you understand the risk of not having it. Gold is the same thing. It's insurance against monetary chaos. And right now, the premium for that insurance is historically cheap relative to the risks we're facing. Look at what's happening with inflation. Official numbers say inflation is around 3%. But anyone who buys groceries or pays rent or fills up their gas tank knows that's not reality. Real inflation, the inflation you experience in your daily life, is much higher. Eggs that cost $2 a dozen a few years ago now cost $6. Ground beef that was $3 a pound is now $7. Rent that was $200 a month is now $2,000. Your dollars are buying less every single day, and it's accelerating. The government can manipulate the CPI numbers, they can change the methodology, they can substitute cheaper goods into the basket, but they can't change the reality of what things cost. And here's the thing. This isn't going to get better. The government is running trillion-dollar deficits every single year. They're spending money they don't have, and the only way they can keep doing that is by printing more money, which means more inflation, which means your dollars will continue to lose purchasing power. Gold doesn't have that problem. Gold maintains its purchasing power because it can't be printed. It's real. It's finite. It's the ultimate form of savings because it preserves wealth across time. Let me tell you about something that happened in Venezuela. In the early 2000s, Venezuela was one of the wealthiest countries in South America. They had massive oil reserves. The economy was growing. People had savings. They had retirement accounts. They had what they thought was financial security. Then the government started printing money to fund social programs. At first, it was manageable. A little inflation, but nothing too serious. But it accelerated. The printing increased. And within a few years, Venezuela was experiencing hyperinflation. Prices were doubling every few weeks. People's life savings became worthless overnight. But here's what's interesting. The people who had converted their savings into gold before the hyperinflation hit, they preserved their wealth. While everyone else was watching their bank accounts become worthless, the people holding gold could still buy food, still pay for necessities, still maintain their standard of living. Now, I'm not saying the U.S. is going to experience Venezuelan-style hyperinflation, but I am saying that the same forces that destroyed the Venezuelan currency are present in the U.S. system. We're printing money at an unprecedented rate. We're running unsustainable deficits. We're devaluing the currency. The only difference is the scale and the speed. But the outcome is the same. Currency devaluation, loss of purchasing power, destruction of savings, and the protection is the same. Real assets, physical gold and silver, things that can't be printed or devalued by government policy. Here's another way to think about it. Imagine you're on a ship that's slowly taking on water. The captain keeps saying everything is fine. The crew keeps saying the ship is unsinkable, but you can see the water level rising. You can feel the ship listing to one side. What do? You get in a lifeboat. You don't wait until everyone else realizes the ship is sinking. You don't wait until there's a panic and all the lifeboats are full. You quietly, calmly get yourself and your family into a lifeboat while there's still time. That's what moving into gold and silver is. It's getting into the lifeboat before everyone else realizes the ship is sinking. Because once everyone realizes it, once the panic starts, it's too late. The price of gold will be multiples higher. Physical metal will be hard to find. The opportunity to protect your wealth at reasonable prices will be gone. And we're seeing the early signs of that panic starting. Look at the premium on physical gold and silver coins. The spread between the paper price and the physical price is widening. That means people are willing to pay more for physical metal than what the futures market says it's worth. That's a sign of stress in the system. That's a sign that people are starting to understand the difference between paper promises and physical reality. The smart money is already positioned. The central banks are buying, the billionaires are buying, the family offices are buying. They're not waiting for confirmation. They're not waiting for the mainstream media to tell them it's okay. They're acting on their understanding of how the system works and where it's heading. And that's what you need to do. You need to understand that the ultimate savings plan isn't in dollars. It's not in a bank account earning 0.5% interest while inflation runs at 7% or 10% or higher. The ultimate savings plan is in metal, in gold and silver, in real physical assets that have maintained their value for thousands of years and will continue to maintain their value regardless of what happens to paper currencies. This isn't about speculation. This isn't about trying to time the market or make a quick profit. This is about fundamental wealth preservation. This is about making sure that the work you've done, the money you've saved, the future you've planned for, doesn't evaporate because of decisions made by central bankers and politicians. The choice is yours. You can keep your wealth in dollars and hope that somehow, despite all the evidence, despite all the history, despite all the current trends, the dollar maintains its value. Or you can move a portion of your wealth into gold and silver and know that regardless of what happens to the dollar, you've preserved your purchasing power. The ultimate savings plan is not in dollars. It's in metal. And the time to act is now, while physical metal is still available at reasonable prices, before the rest of the world wakes up to what's happening. Because once that happens, once the panic starts, it will be too late. The lifeboat will be full, and you'll be left on a sinking ship wondering why you didn't act when you had the chance.